I wanted to follow up on the last video I did where I introduced you to the financial statements, and I want to tie that together with what you might actually see in practice. So we're going to look at how these reports would look in a program like QuickBooks or Wave or some other accounting program. So let me just review real quick what those reports were. We talked about the income statement, which is just revenues minus expenses. The statement of owner's equity, which shows the changes in equity during a time period. And then we also talked about the balance sheet, which is assets, liabilities, and equity as of a specific date. And then I briefly mentioned the statement of cash flows, but I didn't show you any examples. Well, today I'm going to actually show you what this looks like in QuickBooks or Wave. So let's look at the income statement first. So in QuickBooks, it's called the profit and loss. And you can run this accrual-based or cash basis. I'm going to talk about cash versus accrual in a later lesson, but usually when you learn accounting in a textbook format, you're learning accrual basis. Okay, so here's the income at the top, and you can see that they have several different income categories and even some subcategories. And then down here, you'll see total income. Okay, and then you can see cost of goods sold. Now, I didn't talk about this in my last video, but cost of goods sold is a separate section. You want to subtract it separately from other operating expenses. And this is simply because if you have a merchandising business, you want to see what the gross profit is. And that's going to be your profit after just deducting the cost of the products themselves. And then underneath that, you would have the rest of the expenses. If you have a service business, you're possibly not going to have a cost of goods sold at all. And then they would have the other expenses underneath that. There is this other expenses category, which we'll talk about at a later point. There's net operating income, which is the net profit from operating the business. And then any other miscellaneous stuff would go down here, which we'll get into that in more detail later on. But down at the very bottom, you'll see the net income or net profit. Now, as far as the formatting is concerned, in a book, you'll probably learn to put the $sign at the top of the column and beside any final totals, but they just put it beside a lot of these totals, which looks very appropriate. And then they kind of have this double underline down at the very bottom, but under the whole thing. So I feel like the formatting here makes sense and reflects something similar to what you might learn in the book. Okay, now let's look over at Wave. Okay, so in Wave, it's actually called the profit and loss, and they say income statement in parentheses. So that makes sense. Okay, and then when I look at it, I'm looking at cash basis right here, but you could go back and forth between cash and accrual. And you can see here that they have income at the top. There's a line for cost of goods sold, but that's zero in this sample company, so it's not subtracting anything. So the gross profit is the same as income. And then the rest of the expenses, the operating expenses, are down here. And then down here at the bottom, you'll see a net profit. So in Wave, they actually have a percentage also, which you might find helpful, but that is not going to be in every program. Okay, so very similar to what we saw, it's just these actual examples are a little more elaborate than what you saw in my lesson. Now let's talk about the statement of owner's equity in the balance sheet. In QuickBooks, there's not a separate statement of owner's equity. The information contained in the statement of owner's equity is going to be in that balance sheet. It just might not look the same as the report you see in a book. Okay, and same thing with Wave. There's not a separate statement of owner's equity here. That information is going to be on the balance sheet. So let's go back to the slide just so we can look at it one more time. So the statement of owner's equity that I talked about was beginning equity plus any additional investments during the period, plus net income minus owner draws, that's going to equal the ending capital. Okay, so that's what you saw here, and then that ending capital carried over to the balance sheet. But in QuickBooks, let's look at that first. Okay, first of all, liabilities are divided into current and fixed or long-term. So this is not something I talked about. We're going to look at this at a later point when we do more elaborate balance sheets. But basically they're dividing it between things that they're probably going to use up or collect on within a year versus things that are more long-term, things that are going to hold long-term, like vehicles, buildings, land, equipment. Those kinds of things would go under fixed assets. And then you see total assets here. And then below that, you see liabilities or debts are also divided into current and long-term. Things you're going to probably pay within a year versus things that are more of a long-term debt paid over a longer period of time. And we'll talk about that in more detail in a later lesson. And then now let's look at the equity section. So it doesn't have beginning equity or additional owner investments here. It's basically just showing you the ending balances of equity. And then net income is on here, but they have a separate line item for retained earnings. So net income is going to just be net income for the current year. And retained earnings would be net income from prior years. So it's separated out between this year's net income versus prior year's net incomes. Now we are going to learn about closing entries and stuff like that at a later point. So technically some of this stuff gets closed out. And at this point, we're just kind of getting an idea of where things fit and how it might look. Okay, and then you have total liabilities and equity, which is supposed to match total assets. Again, the formatting is a little different in that they put dollar signs beside all the totals, and then this double underline is kind of underneath the whole entire line instead of just under the number. And then of course there was no separate statement of owner's equity. All the information would be contained within here. Okay, let's go to Wave and just see how Wave might look different. Okay, so here's the balance sheet. You can see the assets are right here, and they do divide between current and long-term. And here's total assets. And then same thing with liabilities. They're divided into current and long-term. There just doesn't happen to be any long-term liabilities in here. And then equity is down at the bottom. And this looks a little different than QuickBooks. Here's the owner draws as a separate line item. That would have been a separate line item in QuickBooks if there were any draws, but in this particular sample company, there just weren't any. And then you've got profit for prior years, which is technically retained earnings, profit for the current year, and then owner's equity is in here also, which I would say represents the investments, owner equity investments, versus owner taking money out up here under draws. And then down here you've got total equity. If you were to add that to total liabilities right here, it should match your total assets. I'm just going to click on show summary. So you can see that Wave doesn't have a separate line here that says total liabilities and equity to verify or confirm that it matches total assets. But as you can see, this definitely looks different than the lesson that I showed you. Okay, so that's what it might look like. Let's now look at the statement of cash flows. And in the lesson, all I said was it shows changes in cash, and it's divided into 3 sections. So let's look at that. We're going to look at it in QuickBooks first. Here's the statement of cash flows. Here's the operating section. Here's investing, and here's financing. And then down at the bottom, you've got the net cash increase for the period, and cash at the end of the period, cash at the beginning of the period. So what they're doing in this method, there's a couple different methods for doing the statement of cash flows. And what they're doing here is starting with net income and then making adjustments for things that are non-cash. So it's basically a formula that we'll learn when we do a statement of cash flows. Okay, but this is just to give you an idea of what it looks like. And then in Wave, it's right here, it just says cash flow. And you can see that they take a little bit different approach. This looks like it's more of a direct approach where they're just looking at cash transactions. And then here's investing activities and financing activities. And then down here is the overview, and it shows you the net cash change here, which hopefully it's going to be a positive net cash change. The cash inflow you want to be higher than the cash outflow. So when I look at a statement of cash flows, I like to look at two things. First of all, I like to look at net cash from operating activities. I want to see that the cash from operating the business is positive, because you could have a negative here, but a positive down here under financing if you took out a loan. Well, taking out a loan might be helpful to your business, but you want to be able to produce profits. You want to be able to sell products and services and bring in more money than you're paying out. So I think this is helpful to look at. I think the cash flow statement is a very underused report in real businesses. Hopefully this helped clarify the last lesson, and hopefully this gives you more of an idea of how this stuff works in real life. If you have any questions, let me know in the comments below, and I'll see you in the next lesson.